All right, everybody, I'm going to start a lesson, and today is going to be on what you know as a change of character or a change of behavior. I'll talk about how do you detect them, um, and also the issues with them, meaning there's there are major errors, and I'm going to talk about all of that. All right, I mean, major errors in that. A lot of folks think the change of behavior or character is just a big wave or a big volume or something like that. So I'll explain it. The first thing I'm going to do is go over the mistakes. All right. But before I do that, when we're talking about a change of behavior, and I'll also tie it in how to look for a turning point and all that. And then you have a big one right there. So here is your change of behavior. Why? Because it's a big wave in a downtrend, or it has a lot of volume that's much bigger than the prior up waves. So they think that this is a change of behavior or a change of character or whatever, right? So I'm going to explain the errors. Because if you don't get the errors, if you don't know the errors, then it's not going to work. It's just not going to work. All right, the first thing is you have to understand is that change of behavior is just a preliminary step in what's called a turning point. I don't want to call it step one, but I don't know how else to say it. It's just one step in a turning point. And a turning point, what I'm talking about, is a change of trend from a downtrend to an uptrend. So the mistake that's made here is to say, oh, this is a change of behavior, let me buy the pullback. Do not buy the pullback after a change of behavior. This is what a lot of traders do because they think that this change of behavior is ready to go up. It's not. So what the first mistake is buying the pullback. Why? Why is it a mistake? Because the change of behavior is only a step. It is not incomplete. The turning point is incomplete. A change of behavior is not enough to turn the trend. So that comes to number one here, which is that there is no springboard. What do we mean by springboard? We mean a low volume pullback. The low volume pullback is a second step in the turning point. Does it mean it's going to go? It does not. It means that the probabilities have increased significantly, that there's going to be a turn of a trend change, but it does not mean that the market is in markup. It's not. You could say that's highly likely that it's going to enter markup, or it's highly likely that supply is done, but it's not ready. It hasn't entered markup. This also, by the way, is springboard. And if you don't know, Wyckoff said trade springboards. I mean, a lot of folks, what they do is draw two lines and look for support resistance. But the recommendation that Wyckoff had given, what to trade, was to trade the springboard. But somewhere along the line, that all got lost or misunderstood. But if you see both of his courses, where you see the study of the New York Times, section 7 in his course, it's right there where he says trade springboards, and he says this is where to take the position. Anyway, long story short, you cannot trade a change of behavior because it does not confirm a turning point, and it does not confirm markup. In my opinion, you only trade long when the market enters markup. You only trade short when a market enters markdown. Springboards are part of the process of a turning point to go from a downtrend to an uptrend and enter markup, and vice versa. If you have an uptrend, springboards are about to enter the markdown. About to enter. But you need more elements. So the third step is the market must have markup. What is the exact point? The exact point when the market leaves accumulation and enters the markup phase is when you have a breakout above this bar, above this springboard. So let's say it's I just draw it like this, but you get the idea. This is a bar. It takes out it's a thrust. It's a thrust. It's a big bar that takes out, the high before the springboard, and with a thrust. That is your markup bar. That is the point where you enter markup. And that is the right to go long. Markdown the right to go, the right to go short. It occurs right after the springboard. So you have a change of behavior, you have springboard, and then you have markup bar. Markup bar is the right to go long, the markdown bar is the right to go short. Before that, it's a lot of guesswork and lower probability. But at this point, the probability, the risk to reward, everything is in your favor. Because now you're risking a small amount for an entire trend. Dig that. All right, so I've explained. Call this step 1, step 2, step 3. All right, so now what are the mistakes? Because these 3 components make up what? Oh, shoot. This makes up the turning point. The turning point is composed of the change of behavior, the low volume pullback, which is your springboard, and the third thing, which is the markup bar. The markup bar is your right to go long, and the markdown bar, if we flip this downtrend into an uptrend, right, would be the right to go short. All right, just vice versa. All right, so right here, after that third step, you have the right to go long. All right, now, but it's not that simple. I'm going to show what are the mistakes. All right? The first mistake is you're just trading a pullback after a change of behavior. This is a big mistake that's made by many, many traders because it broke a trend line, some shit, and then they try to get it halfway back, and there's a failure. So the first mistake is there's no springboard and no final confirmation of a markup bar, and then the final confirmation is a higher high after that. So right here you'll get a higher high. We call it the fourth step. Right? So that's the first mistake. You need at least the markup bar. And then typically the markup bar will have follow through and get into a higher high, telling you that's the final confirmation. All right? So first mistake is what? No springboard no final confirmation, no markup bar, only taking the trade right after COB. This is a mistake, taking the trade right after the COB. It has no springboard, no final confirmation, no markup bar. So, because the change of behavior could be many things. It could be just it hit a level, so they just short covered. It could be a lot of things. Just an untested level on a higher time frame, short covering, etc., etc. All right. Second thing to know is counter trending. On a higher time frame, right? This, you're trying to go long, but you see this? On a higher time frame, this entire move up here is a pullback. So the change of behavior, a bullish change of behavior, is a bearish pullback in markdown. So this is a big problem because I messed it up. But bullish change of behavior is a bearish pullback in markdown. So if the daily is going down and the hourly or whatever just has a bullish change of behavior, or 5 minute has a bullish change of behavior, that whole thing is a pullback. So it'll get shorted. So bullish change of behavior will not work if when a market is in strong markdown. A bullish change of behavior is a pullback which will get shorted and will go lower. So this is the second major error with change of characters and change of behaviors, is you guys need to know whether whichever higher time frame you use, is it in markdown and am I trying to buy a bullish change of behavior? If it's in markdown and I'm buying bullish change of behavior, there's the likelihood that it's a pullback is very high, and it just messes up. You just have to trade it and you'll find out that it just doesn't work, because this is setting up that like 30, 38 or whatever percent pullback, and immediately get shorted, and it'll also spring and run the stops and all that, create a lot of frustration. So do not, when the market is in markdown, it has red bar, and you're going on a lower time frame to look for a change of behavior, big mistake. Big mistake. It's not gonna work. All right. The third thing is there's no level. So as you know, you need a level. You need a support or resistance level, or whatever level that you use. You need a level. It should be off of a level. In fact, I would say I'm going to add a number 9. Not only should it have a level, but you should have planned to see the change of behavior at a level in advance. Meaning, you should already have a plan to see, okay, it might occur here, it might occur there, an expectation of where it should occur. Because if you don't have that, that means you didn't do the right analysis, you don't know the context. If you don't know the level and the context, the randomness will throw you off. So you should already be expecting where to see it. Where to see that behavior in advance. If that's not there, that means you haven't done the preparation. And if you haven't done the preparation, nothing will work. Any field you go into, if you're not prepared, will fail. All right. So it requires a level and preparation in advance so that you understand the context, the background, and I'll talk a little bit about that and what to see and all that. So. Number 4, there's no ending action. On the left-hand side, typically you will see ending action. I see this all the time. Those who understand wave volume, they know exactly what I'm talking about. Ending action, it comes in 2 forms. All right, ending action comes in 2 forms. One is obviously the climax, and the second one is a lack of demand or lack of supply accompanied with a shortening of the thrust. These are the 2 ways you have ending action. How a market typically ends is through climactic behavior or some type of lack of demand plus or lack of supply, depending on whether it's an uptrend or a downtrend, with a shortening of the thrust. The first one, the market is oversold because of the climax. It typically gets oversold, it pukes, right? So I'm going to add effort reward to this also. All right. Basically, it's high volume. High volume in the form of a climax or high volume in the form of effort reward. And the other one is low volume. All right. There's high volume ending action, and this is low volume ending action. Low volume, typically I'll show examples of this, but if you have a wave, you will, this is what basically goes like this. The waves, the wave volume goes like that, like that. And you see as the market is going down, this wave, then this wave has lesser volume, then the third wave, the shortening of thrust will have very little volume, clearly diverging and showing you that volume is spent on the left-hand side from wave to wave to wave to wave. The volume is going lower and lower and lower, where it reaches a very small amount, and then you have a change of behavior. So this is the second example. The first example I'm not going to go over. Everybody knows what a climax is, right? But basically, these are the 2 types of ways the market terminates. The left-hand side, which is either the climax, and the second one, which you won't hear a lot of, is the lack of demand with the shortening of the thrust, with the wave volume doing this. All right, this one folks don't really clearly see or point out, but this happens. This is what happens, and both of them are ending action. So that's the key point. So where am I? Number 4. There's no ending action. So there's no ending action. You just have to be mindful because chances of it working are not that increased. All right. The other thing is about session open or close. So as you know, in the morning and end of the sessions, right, the price volume activity picks up. If you see a change of behavior around that time, you have to see other indications, because obviously the price volume activity will pick up. So a big wave at that time, out of nowhere, you might think of a change of behavior. And there'll be times when it is. A lot of times it is. But you need to see the other indications, not just the big wave. Because every day at the open and the close, you always get it. You always get a big wave, right? It happens all the time. So how do you know that's a change of behavior? So that's the thing. Don't get confused by the open and the close and say, oh, this is change of behavior. This, especially in the futures, this is what happens. The next is the preliminary buying or selling. The preliminary buying or selling, you think it's a change of behavior. It's not. But there's ways to know that this is preliminary buying or selling, because in preliminary buying or selling, you will not have a springboard. You will just have a big wave up and it'll continue to go down. You will not have a springboard. You will not have these indications. It'll just have a change of behavior, and then it'll start fading off and making a lower low. It will not have this. So that's how you detect and that it's not a change. It's preliminary buying, and it's also preliminary short covering. You know. The seventh one, I've explained, there's no markup bar or markdown bar. The right to go long or short depends on the markup bar and the markdown bar. If it's not there, you're taking a risk. I mean, you're not trading with trend. So, because the trend hasn't turned. The turning point means that you're no longer in a downtrend. You're in an uptrend because of markup. All right? Now, this is when it's going to get even more interesting. Randomness. Okay. Let's say you have a change of behavior, right? And it looks like a change of behavior. You make lower lows, and you get a change of behavior. Is it randomness? Yes, it could be. There's a high possibility. So that's one behavior. The randomness associated with any one behavior is pretty high. What about two behaviors that are consecutive? What about the randomness of two behaviors? Is it as high as the randomness of one behavior? No. The randomness of two behaviors is less than the randomness of one behavior. Now, what about the randomness of three behaviors? Change of behavior, the springboard, and the markup bar. What do you think then? The randomness associated by having three behaviors sequentially is much, much less than the randomness of one behavior and less than the randomness of two behaviors. So this has like a built-in confirmation in itself, because the randomness, you see, the turning point is a process. The idea of having all of the elements of that process sequentially severely reduces the randomness associated with the trade. One behavior, randomness is high. Two behaviors, randomness is lower. Three behaviors, randomness falls down a lot. Imagine when you flip a head, right, it's 50-50, head or tails. But what about two heads in a row? What about three heads in a row? Probability associated of three heads in a row. So that's the idea, similarly. All right, so anyway. And the final thing is, you should have planned to see the change of behavior at a level in advance. This is all about preparation. A lot of times, the preparation is just not done, and you're just looking at a chart and seeing, oh, it's going down, and today this market had this big wave. Aha! Not doing the preparation in advance to expect to see it there. It fails. All right. We must know the context. You must be tracking that market in advance. You must have the level there. You must be following that market as it's going down, watching the volume and the price volume activity diminish or climax. You must be watching all of this, and then seeing this with an expectation that it should turn on this because of whatever. Maybe it's a level, maybe it's a test of the creek, or here it would be test the creek, or maybe it's a spring against a prior low. All of that in advance. Okay. All right. Number 10. Signals. Okay, as you know, Wyckoff used a judgment-based method, which means all signals are accompanied. If you do it mechanically, all signals, you cannot help this. All signals have noise. have noise. So I'm not saying you can't use mechanical signals. I'm saying that they need to be evaluated. Even after they do give a signal, you need to evaluate and have all of this work done in advance. Then if it gives a signal, okay. You know, the signal makes sense. But without all the preparation in the background, etc., it doesn't make any sense. It's a random signal. Right? So I'm not saying you cannot use signals and indications. What I am saying is that all the prep work needs to be done in advance, and then you should be expecting it, and then it happens, and it's a signal. You know, what I'm saying is then it's okay. But if it's just signal trade, if there's a signal, then I'll trade. It just doesn't work like that. I mean, if it was that easy, then the signal guys would be rich, and they would not be selling their signal services at all. At all. All right. So now we're going to take a look at examples, and what the hell is it? This is crude, right? So, and also note, like the signals, they will always, you have to be able to evaluate them. Which ones are right, which ones are wrong. Do not just take them blindly. So, what is this? This is... So over here, for example, there's a change of behavior, right? It pulls back. I'm change the retrace so you can see it, because there's a lot of variability in the market, and you just need to be able to deal with that. So here you have, for example, your change of behavior on 4,000 up, up, up. That would be your LP. Look at the volume up here, 2, 3, 1. That would be your lack of demand. This is your springboard. And then this thrust that breaks it is your markdown bar right there. Right there. So that would initiate it. The second change of behavior, I'm just going to disregard it because the wave is way too big, and already you had a change of behavior. Right? So you don't want to have change of behavior 2 in a row right there. This actually marked down. All right, and that's the markdown bar, which is your right to short, and you're going to get this. Here's another example of a change of behavior. Do you just take the short? The answer is no. What's the amount? 32,000. What should happen after that? You need a pullback. What's the amount? It should be at least 1/3, preferably 1/4. Do you have that? Yeah, you do. Where is it? Right there. Right there. They said less than 1/3. All right. Now you have to wait, and this is even a better one. $32,000. Volume diminishes here, and 7,000. Does it break? No. Oh, this is even a better one. Right? But you need a break. Where's the break? Right there. The red bar right there. Here and here. So there's your, what the hell? Yeah, actually, that's not it. It's, oh yeah, that is it, right there and right there. Those are your right to go short. Now I can't catch them all mechanically, but at least I get the change of behavior. The others sometimes is like really hard to get them. This is an example of a change of behavior. The market is now on a springboard. Now I'm looking for a thrust. The thrust comes, but I mean it's up here, all right? And you just have to, right there, that is a break, and there's your confirmation. Now The only problem is that I'm not sure if it took out. It did a spring, so you just have to be ready. There'll be times when, because the market is in a downtrend, the change of behavior and the turning point, it will spring. So you just have to know how to play stops and all of that. So this here again is also a springboard with a markup bar right there. And that create the markup. See? This is a lack of demand. I couldn't see this clearly, but this actually is, it's not very clear, but this actually does qualify because it's the biggest price in 8 waves. It has your, right there is your springboard, right there is your markdown bar. Here's another example of a change of behavior. The pullback here has too much volume, but in terms of distance, this would work. And then you have your markup bar, I think right here. Here or this one of them. But I mean, it's not clear. And that's what I'm saying is that you have to have judgment. You have some springboard right here, right there, and then the mark down bar right here. This is the counter trend. So as I explained, the counter trend, as you can see over here, it's going to get shorted. So don't trade because this whole thing is just setting up the pullback to get shorted, right? I'm not doing any additional filtering because I just know that, when it's in what phase. Here, change of behavior and confirmation, blah blah blah. Oh, this one is the. Let me see if it's an uptrend. Okay, this also counter trend. Actually, I'm not really sure. This is the. And this one worked, but the idea is here. You have the change of behavior, you have the springboard, you have your markup bar, and then you just get in on the pullback, and it's going to launch. Here you have your change of behavior, but you don't have a springboard. This is the pullback that I try to explain. Do not even think about it, because a change of behavior in a downtrend is a pullback to short in that downtrend. The change of behavior is the pullback. This is what sets up the downtrend. Boom, short it, and it's going to work. You just have to know which ones are that's why it's judgment based. You can get one signal. Remember, one signal is never enough. You need all three. Here, change of behavior, springboard, markup bar, take it. Change of behavior, the pullback, yep. Markdown bar, take the short. Anyway, so this is the idea. You have to know what you're looking for in advance. It has to occur, and all 3 elements need to be there. And if they are there, then you have edge. All right, folks, that's all. Thank you.